start our today's class and the concept that we are learning about dividend policy. Yesterday we have started, we have initiated the subject, we have tried to understand various kinds of different policies, different dividend theories, etc. We'll quickly recapitulate that, enter into uh, new areas, and in between you had some queries also. I understand those queries will also be addressed. So right now I'm going to share with you the relevant screen. Just wait a minute till the time I'll be able to share the screen. Just wait a minute. I think you are able to see the screen.
Yes, sir.
Dividend policy you are able to share, right? Okay. You are able to see the screen. Just let me do some
Yes, sir.
kind of setting adjustments. Yeah. So we have understood the concept of dividend. We know this is decisions are taken when we talk about the dividend policy. We take a policy decision about how much is to be retained by the company and how much is to be distributed to the shareholders. That is basically the concept of dividend decision, the concept of deciding on a dividend policy. Right. In that context, we have seen there may be various kinds of dividend policies. For example,
There may be various kinds of dividend
regular dividend
policies.
policy,
For example, we can
stable
regular
dividend
dividend
policy,
policy,
irregular dividend
stable
policy,
dividend policy,
and no dividend.
irregular dividend policy, and no
सर
dividend.
आपका बहुत इको हो रहा है
Okay,
Sir,
please,
आपका बहुत
please
इको हो रहा
mute,
है.
please
Please,
mute your speaker. Then we'll try.
please mute your speaker. Then we'll try.
Both of you. Now let us listen. I think it is okay now. When some queries will be there, then unmute. Then we'll see. Okay. In case some queries are there, just unmute and speak to me. Because when you are unmuting, we are getting the echo noise. Well, friends, so we'll continue our discussion. So these are the various types of dividend policies: regular, stable, irregular, and no dividend policy. In case you have some query, you may unmute and speak, but immediately again mute your speakers. Otherwise, we are getting the echo sound. What is regular dividend policy? What is stable dividend policy? What is irregular dividend policy? What is no dividend policy? All these concepts have been discussed in your last class. Okay, I think you have remembered. Otherwise, you can go to the videos which are uploaded and you can see those videos. You can recall that thing. And what are the determinants or constraints of dividend policy? Various points are there. We have discussed all these points: legal considerations, stability of earning, opportunities for reinvestment and growth, financial considerations, cash flows, level of inflation, all these things, effect on.
पेपर प्रॉफिट मीन्स व्हाट
Yeah, what is your question?
पेपर प्रॉफिट
Paper profit means book profit. Okay, that means that is not the actual profit, but in accounting. But in accounting books, we have been able to show some kind of profit. It's not exactly cash profit. Okay, in the context of dividend policy, what we call as the paper profit, that means what I was explaining you in our previous classes. That means what is exactly happening. Take an example of the depreciation, right? In the company's book, we provide depreciation on the historical cost of the asset. Asset might have been
Cost of the
purchased
asset.
some
Asset
time
might have been
ago
purchased
when
some
the
time
price
ago
was less
when the price was less
and depreciation was charged on that.
and depreciation was charged on that.
Okay, and now what is happening? Now we are charging. Sorry, we are on the historical price. We have paid some price, and now we are charging depreciation on that historical cost. Consequently, there is every possibility that by this time the value of the asset might have gone up, and through this process of charging depreciation, we are creating a fund to replace the asset. But this fund that we are creating, that may not be sufficient to replace the asset, because in an inflationary situation, the value of the asset might have gone up. Right? Price value of the asset might have gone up. So the depreciation is insufficient. If you provide depreciation or if you try to create a fund on the today's cost of the asset, then profit will be less. Okay, that means the profit we are having is that means the fund we are having to replace the asset is insufficient. Okay, why it is happening? Because depreciation are charged on a historical cost, not on the market value of the asset. Consequently, through this method, the profit we are arriving at is not the real profit. It is a profit. It is a kind of accounting profit. We can call it as the book profit, or we can call it as the paper profit, but are not real profit, because the provisions we are making to arrive at the profit are not sufficient, are insufficient. These provisions are not made on the
Yes.
market value of the asset. Have you understood?
Yes.
Now unmute and
Yes, sir.
reply.
Yes, sir.
Meghna, did you understand? Okay, I think this point is clear. You have understood what is paper profit?
Okay, I think this point is clear. You have understood
Sir.
what is paper profit?
Yes, sir.
Okay.
Yes, sir.
Right. Now, the other
Now,
query,
the other query,
one more query Rosalie has raised just before
one
the
more
class.
query Rosalie has raised.
Now, please mute your speaker so that I can talk.
Now, please mute your speaker so that I can talk.
Okay, now let us listen. The next query.
Okay, now let us listen. The next query we.
I'm getting that echo noise. Both of you have muted your speakers. Yeah, I think it's okay now, so we'll be able to discuss. Uh, yeah, what we are discussing, that there is one more query which was raised by Rosalie, that how come it is possible that the declaration of dividend might be beneficial to some of the shareholders or some of the investors, but may not be beneficial to the other shareholders. Okay, we need to understand this concept. You see, uh, there are many reasons on many grounds we can say. For one shareholder, a particular dividend might be beneficial, other shareholder it may not be beneficial. Now, one example I'm just telling you. Suppose you can say one shareholder has got an opportunity to earn at a particular rate. Suppose, let us take an example. One shareholder has got an opportunity, or has got a chance that if he'll receive some money, he can earn at the rate of 25%. 25% per annum he can earn. So if that kind of shareholder receives the dividend, then he knows he can maximize, he can bring a income on that dividend at the rate of 25%. But let us say another shareholder who has got opportunity to earn at the rate of 10% or to earn at the rate of 5%. Let us say he has got an opportunity to earn the income at the rate of 5%. If he gets dividend, then what will happen? He can maximum earn at the rate of 5%. So one shareholder is capable of earning at 25%. Another shareholder is capable of earning at the rate of 5%. Right? But let us say if dividends are kept with the company, let us say company can grow at the rate of 15%. Understood? Are you understanding the situation? Company can grow at the rate of 15%. One shareholder can earn at the rate of 25%. Another shareholder can earn at the rate of 5%. If that is the situation, the person who is capable of earning 5% only, you will see, okay, dividend should not be declared. Because if it is kept in the company, company is growing at the rate of 15%, which is better for him because he is a shareholder of the company. Ultimately, his shares value is getting maximum. But the shareholder who is capable of earning 25%, what you will feel? Okay, you will feel that better I should receive dividend. So that company is going at 15%, but if the same money is kept by me, then what he can do? He can earn at the rate of 25%. Therefore, the payment of dividend has different impact on different kind of shareholders. I think point is clarified. Then you now please unmute your speaker and reply me whether you have understood or not.
सर लेकिन एक कंपनी कैसे डिफरेंट डिफरेंट पर्सन के डिविडेंड डिक्लेयर कर सकता है?
नहीं नहीं, डिफरेंट पर्सन के लिए
मतलब
डिफरेंट डिविडेंड डिक्लेयर नहीं कर सकता. A particular dividend will be declared, but that might be beneficial for one shareholder, may not be beneficial for another shareholder. But it's not possible that two different kind of different dividends can be declared. Two different kind of dividends are, there is a possibility. That possibility is that when the shareholders have differential rights, it is possible to have different kind of shares. Okay. Class A share, class B share, that possibilities are there. Companies Act permits that thing also. Right? If you can go through that chapter, the variation of shareholders' rights, shareholders' right, you can understand it's possible to have different kind of dividends. But normally we are not talking about that. One company can normally issue one kind of dividend, but the same dividend has got different impact on different shareholders. Okay, if you want to understand this concept, that variability of the shareholders' rights, then there is one more video available at the website. You can check that thing. You can go through that how it is possible. Now, have you understood the query, or still you have uh, something
No, sir.
to ask?
It's clear.
It's clear, no? Okay, right. So
Yes,
we'll
sir.
move ahead now. So these concepts, the determinants or constraints of the dividends are important. Please clarify your doubts, because these are conceptual issues. Uh, I feel that at the conceptual level, everything should be clarified. And also in the previous class, we have discussed that these are the various types of kinds of dividend, like cash dividend, bond dividend, stock dividend, and property dividend. We have understood all these things. No need to elaborate. You can see all these concepts. But in case you have some queries, then you can raise your query. And this is what I had shown you. Various kinds of dividend policy theories are there, but we'll be focusing on these three theories because this is there in our syllabus: theory, Walter's model, and Gordon's model, right? And we can divide these theories into two categories broadly. One is called relevance of dividend. On the basis of relevance of dividend, that means these two theories says that dividend is relevant. And the other theory, approach, or the model, or theory, says dividend is irrelevant. Understood now? So Walter model or Gordon's model says dividend is relevant. Relevant in the sense dividend has some impact on the value of the firm. But approach says dividend is irrelevant. That means dividend doesn't have any impact on the value of the firm. Are you getting broad classification? Are you getting?
Yes, sir.
Okay. Now, then in the previous class, we started this Walter model. Okay, this particular theory is founded by James C. Walter. We have understood the concept. I had shown you his photograph. He says that dividend is relevant. Okay, certain assumptions we have understood. These assumptions that the firm finances all its investments through retained earning. Okay, that means there is no outsiders funding. If some money is required, the firm will use its retained earning. That is assumption number one. Then the internal rate of return, which is R, that is the return of the firm, and the cost of equity, which is KE, the cost of capital, are constant. R is constant, and the KE is also constant. Okay, this is the assumption. Okay, try to recall. These are certain assumptions which Mr. Walter has used. By using this assumption, he has tried to prove. Okay, and some of these assumptions may not be practical. That is why if that something is not practical, that will be taken as a criticism to the theory. Okay, understood.
Yes, sir.
Now, third point is that
Yes, sir.
third assumption is that all earnings are either distributed as dividend or reinvested internally immediately. That means dividends will be either distributed or kept as retained earning. There is no third option. Either I'll distribute or kept as retained earning, which will be used for the business. Okay.
Sir,
Then
reinvested internally.
internally means the farm will be using, not external investment. Farm will not give it to outsiders. Farm will use for its own purpose. Right.
Yes,
And the dividend and the earning, the dividend as well as the earning, dividend per share and earning, they also do not change. They will remain constant. And the farm has a long life or an infinite life. Farm will continue forever. These are the five assumptions we have we have to consider under Walter's model. Okay.
yes, sir. Yes, sir.
Now, if these are the assumptions, last class I had tried to explain you the formula which is developed by Walter. What Mr. Walter says that the P means the price or price as of today. You can say it a P0 also. P0 is also price as of today. What is price as of today? How we will arrive at D, that is dividend, plus R. R means return, rate of return of the farm or internal rate of return of the farm, divided by KE, that is cost of equity, multiplied with E minus D. What is E and what is D?
E is earning per share. D is dividend per share.
D is dividend per share.
Right. We can say it is EPS by DPS.
You can say it is EPS by DPS also we can.
Right, that is earning per share and minus dividend per share. That means net effect is that earning minus dividend means what I am getting the retention. Is it not? I have earned this much, I have distributed this much. So balance is by retention. Okay, that I have to arrive at the present value of this thing. Therefore, I am dividing it with the cost of equity. By dividing with cost of equity, I will be able to arrive at the present value. In fact, if you analyze the formula, if I divide the formula into two parts, okay, into two parts, I'll be showing you subsequently. That which I'm talking about the dividends present value plus retained earnings present value, and this retained earning will grow at this rate. So this retained earning subject to a growth and the present value of that thing. Okay, and that is the value of the dividend. That is the value of the equity share. That is the price of the equity share. Okay, that is his theory. Understood? That means he in fact says that dividend is relevant because here is dividend is taken into account. Here also dividend is taken into account. And he also says the price substantially depends upon this part. That is earning minus dividend. How much you are retaining, that will affect the price. I think you have understood this concept. Are you getting me?
Yes, sir.
Oh,
Yes, sir.
fine. Okay, and this concept I told you last class also you have seen the present value. That means this formula says the price of the share is the present value of an infinite stream of constant dividend. Dividend is constant. So present value of the dividend and the present value of the gains. Okay, this is one part d by k. This is one more part r by k into e minus d divided by k. This is one part. So these two factors or these two elements contribute towards arrival of the price, arrival of the share price. This is what that theory says. Then we have understood that if R is more than K, that means firm's rate of return is more than cost of equity, then that will happen, firm should retain the entire earning. Firm should not distribute anything. If R is more than K, firm should retain the entire thing. And if R is less than K, then firm should distribute everything. And if the R is exactly equal to K, then it doesn't matter. Firm can take decision to make any kind of payout that will not affect the value of the farm. Okay, right. On that basis, we are classifying the farms into three classes. One is called what kind of farm? We call the first category of farm is, can you read it?
Growth farm.
Growth farm. Growth farm is R is more than K. These are the farms which are growing. Farm's rate of return is more than its cost of equity. And if that is so, then the payout ratio should be 0%. That means farm should not pay anything. Everything he should retain. Because farm can grow at the faster rate. Shareholders, let us say, expecting at 8%, but farm is growing at 10%. So farm should not declare anything. Let farm grow because farm's growth is more than shareholders' growth. Understood? If R is more than
Yes,
K,
sir.
then payout ratio should be 0. Then we are talking about the normal farm. Normal farm means R is equal to KE. That means cost of capital, cost of equity, and the return on the investment are same. R is equal to K. Okay, if that is so,
Yes, sir.
we call it the normal farm. In that case, any kind of payout ratio is optimum. That is best ratio. Whether you pay 10%, 20%, 30% out of your profit, whatever you want to distribute, whatever you want to retain. If the farm is a normal farm, then it will not have any impact on the value of the farm. So any ratio is a good ratio if it is a normal farm. But in case it is a declining farm means, as you can see, R is what is the
Less
relation?
than K.
R is less than K. That means shareholders are expecting, let us say, 15%, but farm is earning 12%. Farm is earning 12%. We call it as R is less than K. We will be considering it as the declining farm. If it is a declining farm, then what Mr. Walter suggests, that pay everything, pay 100%. Because you are earning as a farm is earning less. So let every money, entire money should be given to the shareholders. Right? So payout ratio should be 100%. Understood this concept?
Yes, sir.
Okay. Now, the same thing I am showing it to this chart. You see, I'm classifying the farms into three parts. Growth farm where R is more than K, normal farm when R is equal to K, and declining farm where R is less than K. If it's a growth farm, farm should pay less dividend to the extent possible or pay zero dividend. If it's a normal farm, then farm is indifferent. Any kind of dividend can be paid. And the declining farm, then farm should pay more dividend. Maximum dividend should be paid. Okay. And considering that
Yes,
thing,
sir.
we are calling this theory, or this theory is also called as, popularly it is called as all or nothing theory. That means either distribute all or zero, nothing. Okay. If it's a declining farm, then pay all. If it's a
Yes,
growth farm, then pay nothing. So you can say it as the all or nothing theory. Are you getting me?
yes, sir.
Okay, fine. Now, once again, I am trying to explain that formula. That formula is fundamental for our understanding. So this thing, I am now breaking the formula into two pieces. You know, the same formula, how I am showing it, purposefully I am making it into two pieces. That means P0 is equal to D by K plus R by K multiplied with E by minus D whole divided by K. So this talks about the present value of retained earning. This talks about the present value of dividend. And both the things, both the elements will contribute towards the price, towards the market price of the share. That is the formula. Okay, we need
Yes,
to
sir.
understand the formula. We need to understand how the formula has been derived. I think I have clarified that. Another way of expressing the same formula is almost same thing. D, here instead that D I am calling it D1, that means future dividend or expected dividend. And since it is dividend is constant, so D0 is equal to D1 is equal to D2, dividend is always constant. I am writing here expected dividend divided by cost of equity plus R by K multiplied with EPS, earning per share minus DPS, dividend per share. The same thing,
DPS.
E minus D, I am calling it as EPS minus DPS. I am getting present value of the retained earning. This is another way of expressing that formula, but formula is same, the different ways, different textbooks and different places you can find different kinds of expression, but we need to understand the concept behind this formula is like this. Present value of dividend and present value of the retained earnings subject to growth is the value, is the price of the share. Okay, having understood this,
Yes,
now we are in a position to solve a question. This question has been framed for you. I think you have kept pen and paper ready. Will be in that solving the question. Is it readily available with you? Pen, paper, calculator. This
yes,
question
sir.
we may not need calculator, but pen and papers are required. We have to read. Okay, I think Meghna, when you are talking, we are getting echo. I request Rosalie to read this question.
The investment opportunities associated with five companies are given below. Keeping in mind the risk profile associated with those investment, investor expectation of return has also been uh,
Chalked out.
ch- clagged, clagged out.
Chalked out.
Decide the optimum payout using all or nothing theory.
You know what is all or
Company,
nothing theory? That is the
yes,
Walters
sir,
theory.
Walton theory.
Okay. Now this is the
Yes, sir.
company. Companies are A, B, C, D, E. Now return from investments as a percentage. It is expressed 12%, 15%, 14%, 16%, 13%. Shareholders are expectation. Shareholders expectation means what we can call it as, it is 12%.
K.
K. This is
K.
K, and upper one, this one is
R. Small
R.
R.
This is R. This is K. Right. Okay, it's
Yes,
12%,
sir.
17%, 13%, 16%, 15%. The question is asking use all or nothing theory. All or nothing means you have to see we are
Yes,
talking about the Walters theory. Okay, it
yes, sir.
says the investment opportunity associated with the five companies. There are five companies. This is their return from the investment. This is the shareholders' expectation of the cost of equity.
Yes,
We
sir.
have to suggest what they should do. Okay, what is their payout? How much they should pay? We have to answer this question. Okay, how to answer? I am giving you a
Yes, sir.
particular format. In this format, we have to give the answer. Okay, this is the question. Just have you understood the question?
Yes, sir.
Now we'll answer in this particular format. I expect you in your paper write like this: KE data is giving you. I am giving in the column. R is like this thing. Now here is relationship. When you are writing relationship, you have to write KE is less than R, or KE is equal to R, or KE is more than R. All these relationships first you write. Okay. Just write one case. First case, let us say KE is equal to R. Second case, KE is more than R. Third case, like this you write down
Yes, sir.
relationship. Okay. Write down all these things, all the
Yes.
instances, write down, then we'll check whether answers are
Yes, sir.
right. Okay, quickly write down. Is it over? Have you written the relationship?
Yes, sir.
Okay. Now next column you write company type. That means identify whether it's a normal company or growing company or a declining company. Okay. Just write down on the basis of relationship. You have to take a decision whether it is a growing company, normal company, or declining company. By seeing the relationship, please write down your answers.
It's completed, sir.
Completed. Now the last column, that is payment column, you write down whether it is how much dividend has to be paid, whether 100% or 0% or any amount or any percent, 100%, 0% or any percent. You have to write down.
Yes, sir. It is
Completed.
completed.
Meghna, did you
Yes, sir.
complete? Okay. If you have completed, okay. Now I'm showing you the answer. Please check whether you are right or wrong. How many mistakes you have committed, or all are right?
All are right.
Very good. And let me tell you, this is one of the questions which is asked in one of the professional examinations. Okay. You see, very simple questions. If you know the concept of Walter's model, you can very easily take a decision by applying all or nothing theory, that how much dividend has to be distributed. Okay, good that you have done it correctly. Now, that gives us an assurance that you have understood at a conceptual level the theory. But the next question we are going to move. Now, again, you have to read this question. Question number 2. Please, Rosalie, you read it.
Earning per share of a company is rupees 10. Its internal rate of return is 15% and the capitalization rate of risk class is 12.5%.
Now tell
If
me what is
Walter's
R, what is
model is
K?
used,
What is R, what is K?
R is 15% and K is
Okay,
12.5%.
okay. Now proceed.
If Walter's model is used, first question is what shall be the optimum payout ratio of firm? And the second question is what would be the price per share at this payout? Third question is how will the price change if a different payout is employed?
Okay, so now let me explain you this question. Question is a very simple question. Earning per share is 10%. So this earning has to be distributed, partly it to be retained. Company earns at the rate of
Yes, sir.
15%, R is 15%, capitalization rate is 12%, KE is 12%. Okay, we have to decide what is the optimum payout ratio. What would be the price per share at this payout? What? Okay, first we'll decide what is the optimum payout ratio. At that payout, let us say optimum payout, when you are following all or nothing theory, optimum payout may be at 0 or 100% or maybe any payout ratio. Okay, it depends whether it's
Yes,
a
sir.
growth farm or declining farm or a normal farm. But seeing the situation, you tell me whether it is a growth farm or normal farm or a declining farm.
It is a growth farm.
Growth farm, because farm's earning is 15%, cost of capital is 12%, 12.5%. So cost is less, earning is more. It's a growing. In case of growing farm, what should be the dividend structure? How much? What should be the ideal payout?
0,
Growth farm,
0 point.
zero payout. So that means the first question it is asking, if zero payout ratio is there, what will be the value of the farm? What will be the share price of the farm? So you have to apply that formula. That formula you have used.
Yes, sir.
Okay. So by
Yes, sir.
applying that formula, you have to solve the question. Again, I am giving a structure to solve this question. Structure is like this. Since R is more than K, the entire earnings should be retained. Okay, that is zero should be distributed, payout should be zero. You are also saying the same thing. So no dividend payment, dividend is zero. If dividend is zero, I have to apply the formula. Formula D by K plus R by K into EPS minus EPS
EPS
divided by K. Now
divided
apply this formula, arrive at what is the price of the farm. Please try, use your calculator. Dividend is zero. So 0 by K plus R by K. EPS let me tell you what is the EPS. EPS is rupees 10. EPS is 0 divided by K. Okay. There are multiplications, there are divisions, there are subtractions. So you have to properly solve this question. There should not be any kind of arithmetical error. You need to understand that when you have to do multiplication, when you have to do subtraction, when you have to do division, there should not be any kind of arithmetical error. Please solve this question and tell me what should be the price of this share. Don't worry, even if you are committing some mistakes, don't worry. You have to face this challenge. Have you done it?
6.
Okay, let us see. The correct answer is, you see, you might have committed some mistake. Don't worry. Just you see what you have to do. Okay. First is dividend is 0 divided by KE.
Yes, sir.
What is the KE you see? 12.5% means 0.125.
0.15.
You might have committed some mistake here. This is a lesson for you. You have done it correctly or there is a mistake?
No, sir, it is correct.
It is correct. Plus R by K, that is 0.15 divided by 0.125. Okay.
Yes, sir.
Multiplied with
Yes,
10
sir.
minus 0. 10 is the EPS 0 whole divided by 0.125. If you solve this question, you'll be getting 95. So first part is of course 0. Second part you have to see first. Okay, you have to solve it. I think you are able to do it. 96. Your answer is 96 or 6?
96.
96. That's correct answer. Okay, Meghna,
Yes,
now
sir.
you respond whether you are arriving at the same answer.
Yes, sir.
Okay, good. Now you see, dividend payout ratio is 0, but this is the price of the share, is it not? 96. Now you
Yes, sir.
see, what if the payout is 50%? 50% means EPS is 10, DPS will be 5, dividend will be 5, is it not? Now solve this question.
Yes, yes, sir.
Solve this question. Assuming payout ratio rate is 50%. Got the answer?
Answer 88.
Answer is 88. Very good. Correct. Now, again solve assuming that payout is 100%. That means out of 10, entire 10 rupees will be distributed. Solve the same question.
Only 80.
Only 80. Right? Answer is 80. Meghna, what is your answer?
Yes, sir. 80.
80. Okay. Now you see, when entire amount is retained, that means dividend is 0, share price is 96. You paid 50%, share price is 88. You paid 100%, share price is 80. That means as you keep on increasing your dividend payment, the share price is reducing. Therefore, it is better
Yes,
to
sir.
keep zero dividend. If you pay zero dividend, share price will be maximum, and investors will be happy because that brings the price appreciation in the shares.
Ma-
Even if they are not receiving any
Yes, sir.
dividend, but this brings a price appreciation. The share prices are increasing. So that brings indirectly a kind of wealth maximization. So they will be happy. So that is what the theory says. If this is the kind of situation, don't pay any dividend, because without paying any dividend, you see prices are more. If you pay, then prices are less. Understood?
Yes, sir.
So declaration of higher dividend has resulted reduction in the market price. If I am declaring higher dividend, market prices are reduced. Okay. Okay. Now one more
Yes, sir.
example we'll see. This is in fact an example from the study material. You see, this question says that you see R is 0.12, that is 12%, K is 10%. Okay, earning per share is 4, dividend is 2. Then what is the market price using Walter model? So similar way, if we apply, you can easily do it. The market, it will be, you see the what is the price? 2, that is
2.
dividend. Okay.
Yes,
Okay. Then R
yes,
by
sir.
K, 0.2 by 0.10, 0.12
And
divided by 0.10, multiplied with EPS by DPS, that is 4 by
for
2, whole
by
divided
DPS,
by
that is 4 by
K.
4 divided by 8.
Finally, we are getting figure 44.
Finally, we are getting figure 44.
44.
That is
Okay. Answer is
okay.
right.
Answer is right.
Fine. Now,
yes, sir.
okay. Now, next, the same question is asking, what if the payout ratio is 0, that instead of 2, I am paying 0. If you see, if I am making 0, price is 48. Okay. Now tell me, by not paying dividend, value has been increased. That means share price has been increased. Not paying dividend, paying 50% dividend is 44. Not paying dividend is 48.
Yes, sir.
Now tell me why it is,
48.
why this is happening.
Because in second case, dividend is 0.
Huh. Dividend is 0, but why share prices are increasing? What is the main reason? Primary reason for that, or what is the fundamental reason for that? So the fundamental reason is
R
that you
is,
see R is more than K.
yes, sir.
If R is more than K, it is a
Yes,
growth
sir.
farm. A growth farm, you should not pay any
Yes, sir.
dividend. That is one. Okay.
Yes, sir.
Now, if it is reverse, let us say R is not more than K, this different situation I am taking. I am saying R is 8%. Okay, R is 8%. If you apply, then you will get that price is 36 if I pay 50% dividend. And if I pay 0 dividend, the price is 40. Then if you pay 100% dividend, that price is 40. That means 100% dividend is better here because what? R
R
is
is
less
less
than
than.
K, less than K. So that is the concept. That
Yes,
model
sir.
is called as, this is what Mr. Walter tries to explain us, that this is the essence of Walter's model. I think you have understood these
Yes, sir.
concepts.
Yes, sir.
Okay, now coming
Yes,
to
sir.
the criticisms associated with the Walter model. Most of the criticisms you have uh, already identified. Yesterday also we were talking about this thing in our previous class, that how come it is possible, this kind of assumptions. In fact, the criticisms arises because of those kind of assumptions. First assumption is that this model assumes that all investments are made through retained earning, right? Farm doesn't use any kind of external financing. Farm doesn't use any fresh equity, or farm doesn't borrow money. Then whenever investment is required, farm uses its retained earning or internal equity is used. Okay, and the criticism to this theory is that if that is the kind of situation, farm is not borrowing, farm is not using external finance, then farm is not using its investment opportunities. That means the investment opportunities are suboptimal. That means all optimal use of the funds has not been made. Or all top, that means the possibility of opting for a optimal investment has not been made. Okay,
Yes, sir.
this kind of situation
Yes, sir.
happens when the farm's investment uh, is considered as suboptimal. That means less than the, or you can say lower than the optimal capability, because farm is using only its
Yes,
own
sir.
fund. Farm is not using borrowed fund or external finance which farm could use. Second criticism is that R is constant. That is an unrealistic assumption. You have also identified from the very beginning how it is possible the returns are constant. In real life, returns are not constant, but to understand this theory, to test that theory, to understand the concept of this theory, it has been assumed that R is constant. Assuming R is constant, we are trying to prove that this kind of farm, for the growth farms, should not give any dividend. Declining farms should give maximum dividend. To prove that thing, we have to assume R is constant. But the same thing has to be taken also as a criticism.
Yes,
Okay,
sir.
right. And farm,
Yes, sir.
any kind of uh, that means any kind of payout ratio is good when R is equal to K. If that is the kind of situation, that means uh, this does not, this particular theory, if this is the kind of situation for the normal farm, this theory doesn't give any guidance. Okay, that what kind of dividends policy has to be taken for this kind of farms. Then one more criticism is that K is constant, but in real life, cost of equity doesn't remain constant. K changes, K fluctuates, and any kind of fluctuation. When I say there is a kind of fluctuation, fluctuation means risk, is it not? In our initial classes, we have understood whenever there is a fluctuation in the cash flow, we'll consider that there is. But the moment I am assuming that there is no fluctuation, it is constant. That means I am not recognizing the risks associated with that factor. So that is one more
Yes,
criticism,
sir.
that the risk element is not taken care of, or risk element has not been considered. Okay, these are the criticisms. So as a
Sir,
theoretical element
third
of
point,
this, yeah. Now ask your question.
third point. Sir,
Third
third
point.
point, please explain.
Okay. Okay, you have understood that three different kinds of farm: growth farm, declining farm, and the
Yes,
normal
sir.
farm. What will happen to the
Normal.
normal
Yes,
farm?
sir.
If the farm is a normal farm where R is equal to K, that means
Okay.
what?
Yes, sir.
What you should do? We know any kind of dividend will do. If you try, if R is
Yes,
equal
sir.
to K, if you pay 0%, there will be one kind of share value. If you pay
Yes, sir.
50%, same value will be there. If you pay 100%, same value will be there. Share prices will be same irrespective of any dividend. Now tell me, if that is so,
Yes, sir.
how much you should dividend? How much dividend you should declare? 0%, 100%, 50%, anything will do. So this theory doesn't give us any
Yes,
guidance how
sir.
to address the problem in this kind of situation. Okay, theory has no answer.
Yes, sir.
Theory says
Yes,
any
sir.
kind of percentage will do. So that's one of the criticism of this theory. Okay,
Yes, sir. Yes, sir.
right. Okay, so after, with this, that Walter's model we are going to finish, or Walter model is finished. The next model we are going to learn is about the Gordon's model. Okay, we'll keep it for our next class. This is one more model, another interesting model for us, dividend model. And Next class, maybe probably tomorrow, we'll be learning this particular theory. And again, we have to solve some questions under this theory. Next class also, be prepared, come with your pens and papers. So we'll be learning this Gordon's model or Gordon's. Okay.
Okay, sir. Okay, sir.
I think these concepts you have thoroughly understood. Do you have any query? Then raise this query
Yes.
right now. That's Walter's model. Do you have any query on Walter's model?
No, sir.
It is quite clear. Okay. Gordon's model will be equally easy, but at conceptual level we need to understand it in thorough manner. Okay. After covering this, maybe next class we'll be able to start the next model also, that is MM theory or MM's models will also be covered. Okay.
Thank you.
So thank you very
Yes, sir.
much. We'll catch up in our next class. In case you have any doubt or queries, then mail me or WhatsApp me. I will try to incorporate those doubts in our next class. Thank you very, very
Okay,
much.
sir. Thank
Okay.
you.